Ever dreamed of waking up one morning, sipping your coffee, and realizing you're completely mortgage-free? It's a dream many of us share, but the path to achieving it can be a bit of a conundrum. Should you prioritize paying off your mortgage as quickly as possible, or invest your extra funds in the stock market for potentially higher returns? It's a classic financial dilemma that can leave even the most savvy investors scratching their heads. The answer to this question isn't a one-size-fits-all solution. The best approach depends on your unique financial situation, your risk tolerance, and your long-term goals. The basics: mortgage versus investing. Let's start with a quick look at how a typical mortgage works. Say you have a 30-year mortgage for $200,000 with a fixed interest rate of 4.5%. According to this setup, your monthly mortgage payment would be about $1,013, not including taxes or insurance. Over the full 30 years, you'd end up paying a total of $164,813 in interest alone. That's nearly as much as the original loan amount. Now, let's compare that with investing in the stock market. Historically, the S&P 500 has returned around 8 to 10% per year. If you could choose to invest instead of making extra payments on your mortgage, the returns could potentially outpace the amount of interest you're saving. This introduces the idea of opportunity cost, the potential gains you might miss out on if you focus solely on paying off your mortgage instead of investing that money. In other words, by funneling extra cash into your mortgage, you could be losing out on significant growth opportunities in the stock market. Let's walk through a practical example of paying off your mortgage early. Imagine you're able to put an extra $300 toward your mortgage every month. Now, if you're working with the same 30-year mortgage of $200,000 at 4.5% interest, that extra $300 makes a big difference. Instead of paying off the loan in 30 years, you would cut down the term by 11 years and 1 month, paying off your mortgage in just under 19 years. Even more impressive, you'd save $67,816 in interest over the life of the loan. Now let's talk about pros. Interest savings. One of the biggest advantages of paying off your mortgage is that these savings are guaranteed. Unlike the stock market, where returns fluctuate, paying down your mortgage gives you a predictable return based on your interest rate. In this case, you'd save nearly $68,000, money you'd otherwise pay to the bank, in interest. Peace of mind. There's also a strong emotional benefit to consider. By paying off your mortgage early, you're eliminating a major financial obligation. Being debt-free provides peace of mind, knowing you fully own your home. If unexpected life events or emergencies happen, you won't have to worry about making mortgage payments or risk foreclosure. Building equity faster. Every extra dollar you put toward your mortgage goes toward building equity, the portion of your home you truly own. Not only does this help you pay off the loan faster, but it also opens up opportunities for refinancing to a lower rate or taking out a home equity loan or line of credit, or HELOC. You can use this equity to fund other projects like home improvements or paying off higher interest debts. Cons. Opportunity cost. One of the biggest downsides to paying off your mortgage early is the opportunity cost. That extra $300 per month could have gone into the stock market or other investments where the potential returns are historically higher than your mortgage interest rate. By focusing on paying down debt, you might be missing out on larger gains. Wealth is tied up. Unlike stocks or mutual funds, real estate is not a liquid asset. This means your wealth is tied up in your home, and it can't be easily converted into cash. If a financial emergency arises or you want to jump on a lucrative investment opportunity, you can't quickly access the money you've paid into your mortgage. You'd have to sell your house or take out a loan against it, which takes time and comes with additional costs. Losing tax breaks. Finally, by paying off your mortgage early, you could lose out on some tax advantages. Mortgage interest is tax-deductible in the US for those who itemize their deductions. If you're no longer paying interest, you'll lose that deduction, which could increase your taxable income. Additionally, if you're diverting funds from tax-advantaged accounts like a 401k or IRA to pay off your mortgage, you could also miss out on tax-deferred growth and employer matches. By looking at both sides, it's clear that while paying off your mortgage early provides guaranteed savings and peace of mind, there are trade-offs when it comes to opportunity cost and liquidity. Now let's look at the alternative. What if you took that same $300 per month and invested it instead of putting it toward your mortgage. Let's assume a conservative return of 8% per year, which is lower than the long-term average return of the S&P 500. After 19 years, the length of time it would take to pay off your mortgage early with extra payments, your investment would grow to $160,780. That's more than double the $67,816 in interest savings you'd get by paying off your mortgage early. Pros: higher returns. Historically, the stock market has outperformed mortgage interest rates. While your mortgage rate may be around 4 to 5%, the average return on the stock market has been about 8 to 10% over the long term. By investing, you're giving yourself the chance to grow your wealth at a much faster pace. In our scenario, you'd end up with over $160,000, far more than the interest savings from paying off your mortgage early. Liquidity. Unlike home equity, which is tied up in your property, investments in the stock market are liquid. This means you can access your money more easily if you need it for an emergency or want to take advantage of other financial opportunities. You don't have to wait for your house to sell or take out a loan to unlock your wealth. Employer match if contributing to retirement. If you're investing in a retirement account like a 401k and your employer offers a match, this is essentially free money. On top of that, retirement contributions are usually made with pre-tax dollars, which means you can reduce your taxable income while growing your savings for the future. This can amplify the benefits of investing over time. Cons: risk of volatility. The stock market is inherently more volatile than paying down a mortgage. While the long-term trend has been upward, the market experiences highs and lows. You'll need to have the stomach for potential downturns, especially in the short term. Unlike paying off a mortgage, which offers guaranteed savings, investing comes with the risk that you could lose money during market drops. Increased debt. By choosing to invest rather than pay off your mortgage, you're continuing to carry that debt. This means you're still responsible for making mortgage payments for the full term of the loan. And until the mortgage is fully paid off, the bank technically owns your home. There's always some risk that if your financial situation changes, you could struggle to make payments and potentially face foreclosure. So, while investing offers the potential for significantly higher returns and liquidity, it also carries more risk. You'll need to weigh these factors against your personal finance goals and tolerance for debt. If you're still unsure whether to pay off your mortgage or invest, why not do both? Refinancing could be the key to unlocking that balance. By refinancing to a lower interest rate, you can save money on your monthly payments, which frees up extra cash. You can then split that extra cash between investing and paying down your mortgage. With mortgage rates still low, it's a great time to explore this option. Here's the best part: you don't have to pick one over the other. You can keep making regular mortgage payments while using your freed-up cash to invest for potentially higher returns. This way, you're growing your wealth while steadily reducing your debt. It's a win-win that gives you the flexibility to take advantage of the stock market's growth without neglecting your mortgage. So, what's the verdict? Paying off your mortgage gives you security and guaranteed savings on interest, which can feel like a safe bet. On the other hand, investing offers higher potential returns, liquidity, and the flexibility to access your money when you need it. If your mortgage interest rate is low, it might make more sense to invest your extra funds and let the market work for you. But if you value peace of mind and want to eliminate debt sooner, paying off your mortgage early could be the better choice. If you have detailed questions, you should consult a financial advisor who could walk you through your specific situation. Now it's your turn. What do you think? Would you prefer to pay off your mortgage early or invest in the stock market? Drop a comment below and share your thoughts. And if you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more financial tips and advice.